Nick Parsons of the Thomas Lloyd Group joins us right now on the show. Nick, good having you. Thanks so much for joining in. Yesterday it seemed like the doomsday scenario wherein the Yuan was allowed to drift sub 7, the midpoint now being fixed at 6.9683 per dollar. What do you make of this U-turn? Because if yesterday was a big policy move, then the move today seems to be a very sudden reversal. Or the other indication is that it was not a very well thought out slide that was allowed yesterday, and there's a bit of an arrest that has happened today.
Well, good morning from London. The way I would characterize it is that yesterday was the strategic move and today has been the tactical play. So the big decision has been, of course, to allow the yuan to depreciate and to go through 7. But in the face of accusations that it might be manipulating the currency, tactically, they've just put a midpoint of today's range somewhat firmer than many people whose mathematical models had suggested. So I think tactically it's very astute. I've no doubt whatsoever that the Chinese authorities are absolutely aware of what they're doing and how it would be taken. And we know, of course, that nothing happens in Chinese markets without the implicit support or permission of the authorities, and I think they've actually played this one very, very well indeed. I think if they'd moved the midpoint substantially above 7, that would have signalled an escalation at a fairly delicate time in trade negotiations, and given what's happening globally in terms of geopolitics. And I think tactically this is a very astute move. I certainly, though, don't think it's the end of currency volatility, and probably not the end of Chinese currency weakness either.
Nick, the point is, yesterday a lot of people said going sub 7 is a line crossed in the sand, which is difficult to retreat. Now my question to you is, does today's move make you believe that both sides are putting up a hard face but want a resolution, want to come out of this in a better fashion? And do you think equity markets or asset markets across the world would start factoring that in? Because India, for example, is doing really well in trade today.
Well, it's a very good question, but I stress that I think the strategic move is to put pressure on the Chinese currency. I think it will weaken somewhat. I think tactically the authorities have shown themselves to be in control, and really they showed themselves to be the key driver of the market, because the driver of the exchange rate here for the moment is not the United States. The United States is not in control of this move. The Fed isn't in control. The president isn't in control. The Chinese authorities hold all the aces over the very near term. I think in doing so, they're allowing the markets to stabilize, to get used to the new environment, and implicitly there is always the threat that they can move this a little further at a time of their choosing, should they indeed wish. So I think what we're seeing is a swing in the balance of power back towards the Chinese, and I think that is what is the important takeaway from here. The president is very, very unlikely, I think, to be ordering full-scale foreign exchange intervention. I think that would be catastrophic for asset markets globally. The Fed doesn't meet for another 6 weeks and 1 day, if my calendar is correct. So the Fed is out of the picture. So really, the near term all depends on whatever the Chinese wish it to be. And I think that shift in the balance of power is something that we should really, really take note of. So the market will go where the Chinese authorities want it to go. Of that, I have no doubt.
Yesterday's move also moved the needle in a very big way for emerging market currencies. For the Indian rupee as well, we saw the sharpest fall in about 6 years. Where does it leave, emerging market currencies now?
I think for the next few weeks and possibly even right until the end of third quarter, I think it leaves emerging markets vulnerable to some liquidation. What we have seen over the course of the last 3 or 4 months is that investors globally have increasingly been long of emerging market currencies. So they've bought the rupee, they've bought the rupiah in Indonesia, they've bought the Philippine peso, and they've bought the Thai baht. They've bought currencies that either had strong interest rate differentials or very positive momentum behind them. And they did so largely using the euro as the funding currency. Well, a very interesting thing happened yesterday, which was amidst all the turmoil, the euro rose from 110.5 against the US dollar to 112. And we've seen an absolute scramble from investors to be closing out their short euro positions. So Euro India, Euro Indonesia, Euro Peso and Euro Thai Baht were all had significant moves to the upside yesterday. And I think this position squaring has got further to go. So I would characterize this as being very much headline driven, but then quickly morphing into a position driven squeeze, and I don't get the sense that that yet is over, and I think we could be seeing in the near term somewhat more strength from the euro as investors move to be closing out their positions. If we look at Euro India yesterday, it had the biggest one-day move to the upside for several quarters. So Euro India is now back above 80, Dollar India now back above 70, and crucially for those investors who look at more technical signals as well as factoring in the macro news, Dollar India yesterday moved up through its 200-day moving average. And if you were to take a look at a chart of Dollar India, you'll see it hasn't been there for at least 3 months and possibly 4 or 5. I'm doing this from memory. I've kind of got a picture of it in my head here. And so the move above the 200-day moving average is something that would have made investors very, very nervous. And that itself, for the model-driven algorithmic traders, would have been a signal to head for the exit. So I think we're going to see that position squaring continue for the next few weeks. And I think until things calm down, hopefully towards the end of September, early October, then we're going to see a little bit more pressure on emerging markets. And it's the case that, you know, the selling can just be indiscriminate, because when you have to square your position, you have to square your position. It really is as simple as that. So it's not a question of looking for value, it's a question of obeying the disciplines of trading.
All right. That's for the currency market. Equity markets, Nick, and we've been down 11% from our record highs here in India. On the verge of probably seeing a turnaround, but global markets not being supportive. The last few days, have really washed out sentiment here across Indian equities as well. Does that change a lot in terms of what happens now and the focus now shifting mainly towards the trade turmoil rather than individual markets and earnings performances thereabout?
I think what has changed considerably over the last week is the psychology of investors. And I think the mood, which for the last 2 or 3, perhaps even 4 or 5 quarters has been to buy the dip. Buying the dip, buying every 2% move down in global markets has been the route to success in equity investing. I just feel that buy the dip mentality has probably run as long as it can. I think investors have been shocked and scared by the scale and speed of the movement that we've seen over the last 5 or 6 trading sessions, and I don't think that there's going to be the appetite to buy this particular dip. Moreover, I do feel that there's quite a lot of people who'd be happy to see a further rally from here as an opportunity to further reduce exposure, to further reduce risk, and to say, do you know what, let's just bank what we have and view this as a move to the sidelines for the course of the next few weeks, perhaps even until the start of the fourth quarter. You don't have to be invested all the time. Whatever the asset gatherers tell you, and however much people tell you it's impossible to do market timing, if market timing didn't exist, I'm afraid programs like this wouldn't exist either. I think there is very much a role for active management and for active market timing, and I think people who follow that particular script will be deciding that perhaps this is the time to take a few more chips off the table.
Okay, point well taken. Thanks a lot for that, Nick. Thanks for joining in today and giving us that perspective. Really appreciate your time.